Hello, welcome to It's Your Smarter Money with Dr. Laura and Professor Steve. Today we want to talk about a particular strategy that we've been using. It's actually a tax arbitrage strategy, and it's you may have heard of it before. It's called doing a Roth conversion. What is a Roth conversion? Well, first of all, it's important to know that there's two kinds of IRAs that a person can have. There's a traditional IRA, which has the standard rules where if you contribute to the traditional IRA before taxes, it will grow tax deferred. And when you take it out, you pay your taxes then later on. You can also contribute to a traditional IRA after tax, and that after tax money you don't have to pay taxes on, but any of the growth you still have to pay taxes on. But then there's this wonderful vehicle out there called a Roth IRA. And with a Roth IRA, if you put money in after you've paid your taxes, so it's post taxes, and it grows tax deferred, when you take it out, it's also tax-free. And so a lot of times for some of the younger people, when they come to us and they say, should I start putting money away for my retirement? And they are in a low tax bracket, or even individuals that are actually in a lower tax bracket, we'll suggest a Roth IRA as opposed to a traditional IRA. Yet most of our clients, because when they are working, they are high earners, usually they do benefit from that traditional IRA.
Yeah, and by the way, some 401k plans have the option for a Roth within a 401k plan. And I also want to mention that the name Roth came from, I believe it was I believe a congressman. It was his idea, I believe in the 1980s, to allow people to create these types of accounts.
Well, and Steve mentions the 401k. It also a SEP-IRA, a simple IRA, also are candidates to do a Roth conversion as well. So any qualified money that went in there pre-tax is qualified. And
so Laura brought up a great point here, though. You want to be to choose the Roth versus the deductible IRA. It really makes a lot of sense if you're in a low tax bracket to choose the Roth.
Right. But that's not where a lot of people are right now, Steve, right? Because we have a lot of clients that are in the process of retiring, and they have been earning money for a long time, and they've been socking their money away in a 401k or a traditional IRA and reaping those wonderful tax brackets, thinking that, as the government has told them, when you retire, you're going to be in a low tax bracket. And so when you take the money out, it's not really going to affect you. However, we're not necessarily seeing that with our very responsible clients, because our responsible clients have been saving and saving in these vehicles, and they have large traditional IRAs where they have significant money that they're going to actually have to recognize.
Yep.
And the 401ks for sure. So that's why it makes a lot of sense to do a Roth conversion under certain circumstances. And so what are those circumstances? First of all, if you believe that you are in a lower tax bracket, and so we have folks that are retiring, in maybe they're 60 years old, and they have really no more earned income. They might have some income from other sources, but it's usually low, and their marginal bracket is low and their effective bracket is low. But they do, when we start projecting out into the future, when they have to start taking Social Security, and they have to start taking a pension, and they have to start taking RMDs, they're going to be bumped back up into a high bracket right now. In the future, now.
There's that gap. Like, for example, you retired 62, for example, and you're delaying the onset of Social Security until age 70, and also you don't have to take RMDs until you're age 72. So there could be almost a 8-year gap there where you're in a really low tax bracket. That's the time for those people to start to look at Roth conversions.
We also see situations where people have a significant amount of their financial assets in retirement accounts only.
Mm-hmm.
They don't have that much in just taxable money. And so we know that they're going to have to be sourcing all of their future living expenses out of that qualified pot. And might even have to take out more money than the required minimum distributions. And I do want to define that in case somebody doesn't know what that is. Once you reach the age of 72, it's now 72. Some people may be aware that it used to be 70 and a half. But once you reach the age of 72, the government requires you to start taking money out of this qualified money because they want to get the tax revenue. So at that point, we use a schedule to start identifying exactly how much money you have to take out, and you must take it out. If you don't take it out, there are severe penalties. 50% of the amount you were supposed to take out is going to be penalized. And so you don't want to do that. You need to take it out.
By the way, the first, I believe the first RMD is roughly about 4%. And the number is based on a divisor. And the source of the divisor are the mortality tables for if you're a married couple for a joint life that the IRS has.
Right. So there's the RMD portion, and then there's maybe you have to even take out more money out of that pot because that's the only pot you have. And so you might want to do a Roth conversion. Another situation where you might want to do a Roth conversion is if you have any carry forward losses from some other kind of investment where we can absorb those losses and take advantage of scooting this money over into a Roth IRA, which is a wonderful asset because the Roth IRA, you're not required to take distributions. It can sit there forever. It can sit there forever growing. And when you do take it out, it's completely tax-free for your lifetime. And if it winds up that your children wind up inheriting that money, yes, they do have to take it out within a 10-year period, actually, right now with the new rules. But when they do take it out, it's all tax-free.
It's still tax-free.
And so it's a nice benefit. And it's really nicer than when they get a traditional IRA, they have to pay taxes on it. And they have to be very, very careful about maybe spreading that distribution over those 10 years because you might get too hit. If they concentrate it all in one year in the last year, it might create too much of a tax burden. But with the Roth, they can definitely at least leave it there for the full 10 years and let it grow tax deferred.
Yeah, and we've seen a lot of our clients, their children are in high tax brackets, so having to distribute that IRA, that traditional IRA over 10 years, that could potentially be a lot of additional income and be taxed at a pretty high rate as well.
Right. And one other consideration to make, Steve, not so much in New Jersey, but certainly for folks in Florida, there are several of our clients that are considering retiring in states where they're going to have state income tax. I'm talking to one of you, and you know who you are, who's planning on moving to Tennessee. And I know you're currently making a lot of money, but when you move to Tennessee, you will be taxed in the state as well. And so your brackets are going to, your combined bracket is going to be higher. A couple of people.
By the way, it's quite high in New Jersey, the combined bracket.
Right. But the Florida change to the Tennessee change, it makes sense to actually recognize the conversion while you're still living in Florida.
That's a good point.
Yeah. Okay. This page just shows you the marginal brackets in 2021. As we know, they change every year. Our expectation is that they're not necessarily going to go down, but our hope is that they're not going to go up as much as we initially thought they might, at least not in the near future. But it's something to be aware of. And, you know, the comparison of the married versus the single is something that we want to talk about. And the next slide actually shows the brackets for Medicare premiums. Now,
by the way, they took away the marriage penalty here. It used to be that the married filing joint wasn't quite twice as much as single, the bracket level, but now it is. I believe they changed that in 2017 to make it roughly twice. So you're no longer penalized for being married and being in a higher tax bracket than you would be if you were single.
Right. These are the Medicare premium brackets, and a lot of folks don't realize that there are costs to Medicare. Medicare Part A, no, but B and
Indeed.
Medicare Part B and Medicare Part D, and that whole conversation is for another day. We're not going to get too much into what those different things
That'll be
are.
another video.
But for B, there is a base amount in 2021. That base amount is $148.50 per person. And
Right.
D, it's the plan plus it could be an incremental amount. If you're in a low bracket, a low AGI, modified AGI, D does not have an incremental amount. But once you start moving to higher marginal AGIs, which is your total of gross income minus your standard deduction, minus a couple other nuances that define your modified AGI.
That's another conversation.
Right.
How that's calculated.
But it's affected by your gross income generally. Yep. And so it's important to understand that if you have a higher gross income, it doesn't just affect your taxes, it also affects your Medicare premiums. And what you see in the last two columns here, the monthly cumulative and the annual cumulative, are the amounts above the initial
the standard premium.
Right. So they're above the $148.50 premium. So if in fact you are making your modified AGI is over $500,000 and you're single, you will be paying $433 a month or $5,202 a year extra. If you're married filing jointly and you fall into the brackets, both parties are paying that. So you'll be paying $10,404 a month. And that's 2021.
Yes.
I do want to say something about that. We just found out last month, I think it was, that Social Security payouts were going up by 5.9%.
Yeah, that's what I heard.
Medicare premiums tend to be very closely tied to the increment increases in the COLA adjustments. And so our expectation, and it's going to come out within the next couple of weeks, I believe. In November, it usually comes out on what the next year's premiums are going to be. Our expectation is that our Medicare premiums are going to go up significantly based upon inflationary factors. And so that's something that we all need to keep an eye on.
And I want to mention too, although it's not affected by your income level, keep in mind, we always recommend all of our clients have a Medicare supplement. So you would have that additional cost here too, although that's not affected by your income level, but it is affected by inflation, of course. And typical plan is, another $300 a month, at least we've seen, so for a supplement.
So we're talking about this because we definitely want to make some decisions this year for some of our clients. Some clients, we absolutely know this was the right thing to do. If we've missed you, if we haven't talked to you about this and you think that you are a good candidate, please let us know. But this was an analysis that we did for one client. Steve blocked out their names on the top there. Call them Fred and Wilma, I guess. And they're actually retiring pretty young. They're both, below the age of 60, which is young, but they have a lot of savings. Their savings are almost, their financial assets are almost 50-50 in terms of qualified versus not qualified money. So they have around, just call it 1.5 million in taxable money and 1.5 million in IRA. And they have some other income sources. They have some real estate and so forth. And so one of the things that we did with them, we said, okay, if you're retiring, in fact, this year, next year, you only have those income streams from those other sources. There's no more earned income. You're in a low marginal bracket, a low effective tax rate. And so let's start putting away $75,000 for the next 12 years. And so by doing that, we showed them that, yes, you're going to pay some more taxes. And that's on the red numbers are the negative. It's kind of incremental difference between what you were paying and what you were going to pay. So
that's the additional tax they would pay each year.
It's additional taxes they're going to pay. But then look what happens once they actually start having to take their RMDs. They're not going to be required, because they took $75,000 and they moved it out of their qualified bucket. They're now going to take lower RMDs, which is going to affect them favorably. They're going to have a savings that over the course of their lifetime, if we project them to live to be 100, is going to save them 1.4 million. And it's also going to save them with IRMA. And this is a very understated amount because, as we said, we do believe those brackets are going to be changing quite a bit.
And I just mentioned a scenario where this could make a lot. Where, you know, so for example, you're 75 years old and you have RMDs, but you need additional money because suppose you're buying a car and you don't want to have to pay a lot of additional tax on that additional withdrawal from the IRA. You might decide, well, let me use my Roth this year. You know, it's going to come out tax-free and use that to help fund the cost of that automobile. So that's a perfect example of the use of this as well. By the way, we're going to be getting into the ramifications to your children as well here.
Right. But also, Steve, in their case, they have enough in taxable money that they might not even have to touch the Roth at all.
They may not have to.
So,
right?
so they moved that money over into the Roth, and now they can use their taxable money to buy the car and living expenses. Yeah. Okay. And what's beautiful about that is they moved that $75,000 out. And what I did here was I just projected $75,000 in 2022. Future value based upon a 7% return over the next almost 40 years or so. What's the value of that? Okay, $75,000 the following year. What's the value of that? And I calculated all of that, and it really is over $8 million that they've essentially moved over into this beautiful asset, this Roth asset that now their children can inherit. So. And
there's two important things here. First, with a traditional IRA, the income, the children, if they inherit that, they'll have something called income in respect of a decedent, and they're going to owe income on that taxable IRA when they make the withdrawals, which you'll have to make over 10 years, or they're going to make it all. They can do one large withdrawal at the end of 10 years, but of course that doesn't make a lot of sense in most cases. But in this case, with the Roth, there is no income in respect of a decedent. So while they will have RMDs over 10 years, it's all tax-free.
Right. Or we would tell them to wait till the 10th year actually and take it all out, because then it grows tax deferred. But I also want to mention one thing too. So you might be sitting here saying, well, gee, you know, I don't want to give my children $8 million, or that's not the point. You could. The thing is, you have control over it, not the IRS. You're going to make the decision of how you want to use this money, as opposed to the IRS telling you, okay, now it's time for you to do this.
And by the way, you may decide, well, gee, I want to spend as much money out of my IRA as I can because the children are in a really high tax bracket, maybe higher than you. And so you pass less from the taxable IRA onto them, and maybe you have more in taxable accounts, and you have this huge Roth as well. So you can also, in effect, manage a tax circumstance for the next generation if you're careful.
Okay, and this just shows the different brackets currently in 2021 of a single person versus a married person. And the thing about this is what this actually brings us into is a conversation around a surviving spouse. What if both of you don't live to be 100? So we already saw that if you both live to be 100, it's a benefit to you. But what about if you don't both? One of you passes, and so there. What we see when a spouse passes, the surviving spouse has a compressed tax rate. They have compressed Medicare premiums. They have a lower standard deviation. It's cut in half. It also affects their net investment income. And look at what happens. Essentially, if you have $100,000, if you have $100,000 of RMDs, for example, and you're married filing jointly, well, you're in the 22% bracket. But if you're now single, and you're going to be still taking out the same amount of RMDs if you're around in the same age, although there are some conversations we could have with you if that did happen and there was a significant age differential, but that's a different conversation. But the whole amount of money is going to be taxed at a higher bracket. How does that actually pan out for this couple? It's on the next slide, where we actually show our couple, William and Fred. If we wind up, in this case, we actually had Fred pass away. We usually have the guy pass away first because us ladies live longer. We had him pass away in about 8 years. And so then when Wilma had to start taking her RMDs, well, she was forced actually to take more if she did not do a Roth, even more than was initially planned, and compared to her Roth, and the tax benefit is even more significant. It's almost $2 million, and it affects her IRMA double the amount as well. So she really is going to benefit from the fact that they made that Roth conversion.
That's correct. It's an amazing difference, right?
Yeah. So you know, thinking about it from both aspects, if we both live to be 100, is you're going to benefit, and if only one of you winds up living, that person's going to benefit. It makes sense for this couple, and you know, it doesn't make sense for everybody. I you know, I do want to say that, you know, this is why we don't like to say, you know, everybody should do anything. Everybody should do a Roth conversion. No, everybody should not.
Yeah.
It's based upon your family's unique financial situation. And so that's why we would want to talk to you. If we haven't reviewed your taxes recently, the first thing we're going to ask you when we do this is, all right, let's look at your 2020 filing, and let's talk about how your 2021 filing is different. And that's why a lot of times this is the right time of year to do this, because you now have a better understanding of what your ending income is going to be for the year.
And in a future video, probably in the next couple of weeks, we're going to be talking about end of year planning moves. And we're going to mention a little bit in detail how we look at people's tax returns as well in that end of year planning video. And also there's some opportunities here, which I'll just mention quickly, to actually capture capital gains if you're in a really low tax bracket as well. And it can make a lot of sense. We'll talk about that probably in one of our next videos.
So as always, we appreciate you tuning in. Thank you for watching our video. If you have any thoughts or suggestions, or you want to discuss your particular circumstances, please contact us and let us know what's on your mind. Thanks.